easyJet's board rejected a 625 pence per share cash takeover from U.S. private equity firm Castlelake on Sunday, the third offer in under a week, and now the last before a regulatory deadline expires at 5 p.m. today. Castlelake opened at 560p on 16 June, raised to 600p over the weekend, then returned at 625p before the board shut the door again. The 625p offer values easyJet at just over £4.7 billion. easyJet shares had risen to around 525p by Tuesday morning, a 4% move that prices in some probability of a higher bid materializing before the cutoff. What makes today the sharpest moment in the story is the UK takeover panel's put-up or shut-up structure. Castlelake must declare a firm intention to bid or walk away by 5 p.m. There is no extension available under current rules. The firm, which manages $36 billion in assets from Minneapolis and already holds a 2.14% stake in easyJet through its funds, chose to go public with the 625p offer on Monday after the board refused all three approaches without allowing any due diligence. The board's rejection language is specific. 625p is opportunistic, built on Middle East conflict-affected share prices and short-term earnings, and fails to reflect easyJet's medium-term profit potential. That framing is a direct argument about what screen Castlelake is reading from, and that screen is a war-era fuel cost assumption that changed materially in the week the bids were being made. Goldman Sachs is reported to have indicated it could arrange the debt financing, meaning this is not a speculative approach. Capital is lined up. The question is whether the price clears. The gap between 525p on the market and 625p in the offer is roughly 19%. That gap is the central decision variable for every holder and every watcher today. The board says the gap reflects structural undervaluation. Castlelake says it reflects a fair premium. Both arguments use the same depressed share price as their starting point and arrive at opposite conclusions.
The board's undervaluation claim rests on two assets that do not appear on a short-term earnings screen. The first is easyJet Holidays, the package travel division that the board has described as a capital-light business targeting £450 million in annual pre-tax profit by 2030. Airlines are valued on seat economics, fuel burn, load factors, yield per route. A holiday division that sells margin-rich packages changes the profit structure of the entire business, and it does not show up cleanly in the airline multiples Castlelake used to build its premium and multiple analysis. The second is the fleet renewal program. easyJet is scheduled to receive 90 Airbus Neo family aircraft through fiscal 2028 while retiring 79 older A319s. The Neo family burns meaningfully less fuel per seat than the planes it replaces. For a low-cost carrier, the structural cost improvement from that fleet cycle is a multi-year earnings step-up that is not yet in the trailing numbers. Castlelake is offering 625p against an earnings base that does not yet include the fuel savings embedded in planes easyJet has already contracted to receive. This is the buried assumption the board is exploiting. Castlelake's premium analyses are calibrated to a current fleet, wartime fuel, short-term earnings picture. The board is pricing against a post-renewal, normalized fuel, holiday division maturing picture. Both readings of the same asset are internally consistent, which is why the disagreement is genuine rather than performative. Peel Hunt retained its buy recommendation, describing the current price as a temporarily depressed entry point and noting that the strategic progress predates the current management team. Analysts also point to the airport slot portfolio. At capacity-constrained airports, slots are independently valued assets. easyJet slot holdings at Gatwick, Luton, and Amsterdam were not broken out in Castlelake's offer documentation. A take private that captures those slots at current market prices would represent a material discount to replacement value, exactly the kind of asset gap private equity looks for.
Here is the paradox that sharpens with every hour today runs. The core argument for Castlelake's offer being a lowball is that easyJet's share price reflects a war-era risk premium on jet fuel. That premium is now actively unwinding. Brent crude fell more than 4% to below $80 per barrel on 16 June after the U.S. Iran Memorandum of Understanding was signed electronically, the largest single-session drop since the conflict began in February. By the time Castlelake made its 625p bid on Sunday, oil was already pricing in Hormuz reopening. It has continued falling. The direct transmission from oil to easyJet is structural, not speculative. Jet fuel is derived from kerosene, which tracks Brent with a short lag. For a carrier operating hundreds of short-haul European routes with thin per-seat margins, A sustained move in oil from conflict-elevated levels toward pre-war levels represents a material positive to underlying pre-tax profit, the same profit line the board cited when arguing that Castle Lake's offer misses the medium-term potential. Specifically, easyJet had guided toward more than £1 billion in medium-term pre-tax profit. That target was built on fuel assumptions now being revised downward industry-wide. The critical irony is the timing. Castle Lake is trying to lock in a 625p exit price in the final hours before the variable that makes their discount work, elevated oil, is removed. If the Hormuz reopening proceeds and tanker traffic normalizes over the next 30 days, easyJet's cost base improves without any management action. The war premium in the share price that allowed a private equity firm to argue it was offering a 19% premium to depressed levels disappears. A bid that looked generous on 16 June becomes harder to defend on 26 June. There are genuine limits to this logic. The Hormuz reopening is not yet complete. As of Tuesday, BBC Verify confirmed that only 7 vessels had transited since the deal announcement, with up to 580 ships still waiting inside the Gulf. Mine-clearing operations are required before normal traffic resumes. Laura Lau at Brompton Group noted that even after the physical reopening, strategic petroleum reserve replenishment will keep demand elevated and prices may not return to pre-war levels. The pool contains no closing price data for easyJet today, so figures cited here are intraday. But the direction of oil, and therefore the direction of easyJet's normalized cost structure, is being repriced in real time on the same day as the bid deadline.
For a holder, the decision before 5 p.m. is whether the gap between 525p and 625p represents a near-certain exit or a ceiling on upside. The board has explicitly refused due diligence, which means Castle Lake cannot raise the bid on incremental information. Any higher offer would have to be made on the same basis as the 625p one, which the board has already said it would reject. There is no formal counterbid from a third party in the pool. If Castle Lake walks today, the 4% pop reverses partially, and the shareholder is left with an airline whose near-term recovery thesis just became more credible, but whose share price will need months to reflect it. For a watcher, the question is different. The board's case for intrinsic value above 625p depends on 3 things converging: the Hormuz reopening sustaining lower fuel costs, the holidays division hitting its £450 million target, and the Neo fleet delivering the fuel savings already contracted. None of these is a near-term binary event. The holidays target is 2030. The fleet cycle runs to 2028. The 525p market price is not paying for any of those in full. Entry below the rejected offer price, with oil headwinds diminishing, is the thesis. The counter-evidence the pool carries is real but limited. Castle Lake's EU ownership structure involves 2 named aviation executives, Peter Bellew, former COO at Ryanair and easyJet, and Mark Breen at Waneros Aerospace, holding 51% of a holding company. The board called this structure opaque and a regulatory risk. That is a genuine friction point, not a fabricated objection. European airline ownership rules require majority EU national control, and Castle Lake's workaround relies on partners with limited disclosed capital commitments. If Castle Lake raises the bid, this structural question does not go away. The monitoring variable for both holder and watcher is the 5 p.m. announcement. If Castle Lake states a firm intention to bid, the next confirmation is the price. Anything above 625p would represent a material concession to the board's argument, and the oil tailwind entering the model simultaneously would make such a concession more defensible. If they walk, the recovery thesis stands on its own. The checkpoint becomes the next earnings release, where fuel cost relief should appear in the forward guidance. Either way, the oil variable that Castle Lake used to build its discount is no longer working in their favor. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.